How will inflation hurt your retirement savings? Hi, I'm Scott Hamilton, a certified financial planner, fee-only fiduciary, offices in Austin and Houston. Okay, so the answer to the question is, even a moderate rate of inflation, say 4% over a 20-year retirement, can seriously disrupt a poor financial plan. For example, the prices over that time could double, right? Luckily, stocks tend to outperform cash and bonds and inflation over a long period of time by a wide margin. So let's talk about what a real return is. So this is the actual return less inflation. So what really matters is what you actually are getting after inflation. So example, say you have $1 million portfolio, 4% inflation rate, and a 4% return, say on a CD. Your real return is zero, which is fine. That's before taxes. After you pay taxes, it's going to be a little bit less, right? So if you're retired, a huge risk is having a fixed retirement income, cash, bonds, pensions. So those aren't adjusted for inflation, and we're talking 4% inflation here. So if inflation were to double like it was a few years back, that's dangerous situation right there. The erosion of purchasing power is a real concern. If you got a traditional pension or annuities without the inflation rider, these basically they don't go up. So you could be with a 30-year horizon receiving the same pension or annuity stream of income, and it's not adjusted for inflation. And prices could have doubled or tripled during that time frame. So you'll be withdrawing from your portfolio more and more just to pay for the cost of rising prices. So let's talk about negative real returns. So it's back to the $1 million portfolio, 4% inflation rate. And in this case, let's assume that your return is only 3%. And that gives you a negative 1% return. So you're actually losing purchasing power in addition to the costs going up. So inflation is known as the silent killer. And in the 70s, it was famously bad for disrupting many financial plans. And we're feeling the repercussions of in the last few years when prices really were high. So what can you do? Well, balance your safe investments with a higher return equity exposure, and make sure your real return, track your real return so it's positive. And that's the way you generate legacy wealth or wealth that can be used for you in the future. So 100% cash after taxes, that's dangerous. 100% bonds after taxes and inflation, negative return, risky as well. So be real cautious of being too conservative, because even though it might feel safe, you're losing purchasing power on a daily basis. Anyway, thanks for taking the time to listen. Be sure to like and subscribe and go to our website, Hamilton Financial Planning, and thank you.